Hey guys, welcome. I created this video for anybody who's curious about Bitcoin and wanting to understand exactly why it's so valuable and how it works. And the idea is that by the end of this video, you'll be able to make an intelligent decision of your own as to whether or not you should be buying it or selling it. Now, to truly understand the value of Bitcoin, we really need to look back on the history of money. Around 10,000 years ago, humans were very nomadic. We would travel from location to location, essentially just eating whatever we killed. And so the need for us to be able to store anything or carry things with us was very limited, because actually the lighter we were, the more likely that we would be able to survive. And so in that environment, the thing that worked the best for trading was barter. You have a sheepskin, I've got a tiger tooth, and we need to trade, great. But then around 3000 BC, something happened where we invented some new technologies which allowed us to plant crops. And on the back of planting crops, we could now start to settle down. We didn't have to move around as much. And because we could settle down, the communities that we formed start to grow and bigger. And as our communities grew bigger and bigger, the desires and needs and the ability for us to trade with each other became limited, because we have too many people with too many different desires, and trying to find the exact person with exactly what you need is like trying to find a needle in a haystack. So humans created this idea of a store of value, or a medium of exchange. And essentially what that meant was, if I'm a fisherman and I go out and catch fish for the day, and I come home, now I need to either barter and trade that fish on that same day while they're still fresh. Otherwise, the next morning, I'm going to lose all of the work that I spent the previous day. So I need to be able to store that fish in something else that will retain its value, so that I can store the value of my work. And so over the years, around 700-800 years, we tried storing our work in all kinds of different things. We tried storing it in fish, in animals, in crops, in seashells, rocks, you name it, we tried it. And over about 2,500 years, we figured out that a good store of value has 6 core qualities. Number one, it needs to be durable. If it's not durable, that means it can perish very quickly and our work will get lost. Number 2, it has to be portable. If I'm going from one village to the next, I need to be able to take my money with me. Number 3, it needs to be divisible. I might need to buy a very big item or expensive item, but equally I might need to buy a very cheap item. And I need to be able to divide my money to be able to make those purchases. It needs to be uniform so that I can easily identify it. It needs to be accepted by the entire community, so everybody needs to agree that this is money. And the last but most important one is that it needs to have limited supply. And we'll get into that one more specifically throughout this video. And so then around 2,500 years later, around 600 BC, again, as a result of advancements in technology, we create the ability for us to be able to mine gold and silver. And we realize very quickly that gold and silver are actually the best stores of value, because it meets those 6 core characteristics the best. And so we invent the idea of coinage as money or a store of value. And so coinage would be our store of value for another 1300 years, until the 7th century, when China invented the first paper money. What they realized was, again, as a result of advancements in technology, that printing a whole bunch of money was far more efficient than walking around and storing gold and silver coins. And so they invented paper money and they distributed it to their citizens. But it didn't take very long before the government started printing a whole lot more money than the gold that they actually had. And what did that lead to? Crazy inflation, eventually the collapse of the currency, and citizens came back to using gold and silver coins as their store of value. And what we'll realize is that that pattern actually repeats itself over and over every time we introduce paper money. And so it wasn't until the 1600s that Europe introduced their first paper money. And they went through the same cycle, introducing paper money on the back of gold, having the paper money be overly overprinted, the economies collapsing, and then reverting back to using gold and silver. In fact, by the 1800s, the gold standard was almost universal, where humans understood that gold was the best store of value. And the only time we accepted paper money was when it was backed by gold. And globally, we stayed on the gold standard until World War I, when UK came off the gold standard to be able to fund its war efforts. And that happened across Europe. And then by 1944, Europe's economy was completely decimated as a result of World War I and World War II. The US ended up with large amounts of gold reserves. And so everybody agreed that it made sense for the US to be the world's reserve currency. What does that mean? They have all the gold, so they're going to print their dollars that are backed by gold, and everybody else's currency is going to derive its value on the back of the dollar. And that suited the US very well, because it created a tremendous amount of strength and power in the global economy. But almost like we're goldfish, the US forgets how we ended up in this position in the first place. And by 1971, President Nixon takes the US off the gold standard. Why? Because it's almost like a drug. When government has the ability to print as much money as they want with no oversight, that's what they do. It's like a kid in a candy store. You can't let a kid walk into a candy store and say, you're only allowed to take one sweet, that's it. Of course they're going to take more sweets. And so when you look back on that history of money, there's a couple of key points that we take away. The fiat money, the paper money that we rely on so heavily today, only has its value as a result of the gold that sits behind it. And why does gold have so much value? Is because it meets those 6 qualities of a good store of value better than any other product or commodity in the history of humanity. And it meets one particular characteristic the best out of any other asset: supply. And why is that? So when you think about gold, it is the one commodity that we have that is not consumed in the production of anything. It's used in jewelry, but you can always melt that jewelry and reaccumulate the gold. So the total amount of gold that has ever been mined, that supply still exists. It's not been utilized in anything. And the total amount of gold that is mined every year, the new supply that comes on every year, equals about 1 to 1.5% of the total amount of existing golds. So if you have 100 units of gold that are available that have ever been mined, 1.5 units of gold is the amount of new gold that comes onto the market every single year. And even if we double the price or triple the price of gold, the amount of new gold that comes onto the market is only about 1.5% every single year, because we're limited by the amount of gold that we can mine. And that gives us something called the stock to flow ratio, where the total amount of stock divided by the amount of flow, new supply of gold that's coming onto the market, gives us a ratio of about 59, which is the highest of any commodity in the history of humanity. And the reason why that's important is because when we look back on the history of time, whenever a community that used gold as its form of money tried to conquer a community that used anything other than gold, the ones who used gold as their form of money always won. And the reason is because the ones who used the hardest form of money was able to come into the market with the weaker form of money and buy up all of their assets very, very cheaply. Let me give you one example. In North Africa, they used to use glass beads as a form of money. And when the Europeans came in and realized that North Africans used glass beads as a form of money, all they did was they went home, manufactured glass beads, came back, and bought all of these high-value assets for very, very cheap, because they understood that glass beads was not a good form of money. And that same pattern has happened countless times across the globe, across time. And so ultimately, to be able to succeed long term, you need to have the hardest form of money. And that is where Bitcoin comes in. When we think about the 6 qualities that makes a good store of value, Bitcoin outperforms gold in every single characteristic by a landslide. Durability, it's digital, so it can never be damaged. When it comes to portability, it's infinitely portable. In fact, even across planets, because it's digital. It's infinitely divisible. It's perfectly uniform. It's now becoming globally accepted. And here's the most important one. It's first asset or commodity in the history of humanity that has a limited supply. And what does that mean? Its stock to flow ratio is actually infinite. So the question becomes, if you want to store your value of your work in any asset, we know now from history that you want to store it in the hardest form of money. And the hardest form of money needs to have those 6 qualities that we discussed. But most importantly, the hardest form of money from a supply perspective means that your stock to flow ratio needs to be as high as possible. And Bitcoin has a stock to flow ratio of infinity, while gold has a stock to flow ratio of 59. So which asset do you want to store your value in? We also know that the best store of value is a function of the technology that we have at the time. And until 15 years ago, the best technology we had was gold. Today, that's very, very different. So let's just unpack for a moment. What is Bitcoin? Bitcoin is a blockchain. So what is a blockchain? It is an accounting entry system that lives in the public domain for everybody to be able to see. Now, very simply, how does it work? You have a series of transactions that happen in the network that are aggregated into something called a block. Once that block gets validated and authenticated, it gets added to a chain of blocks, creating a blockchain. That's simply it. Now, how do the transactions get validated? That's where we introduce the idea of something called a miner. So here's what happens. A bunch of transactions get aggregated into a block. That block gets encrypted and gets sent to all the miners to say, you need to validate that this block is valid. And the way that you do it is by spending resources to be able to decrypt the block. And because you've spent the money to decrypt the block, you are positively incentivized to validate it properly. And so what happens is all of these computers in the network are competing to decrypt each individual block. And the one who succeeds gets paid in Bitcoin. And before that block gets posted to the blockchain, all of the other miners in the network have to agree that the one who decrypted it honestly and accurately. And once they all agree, then that transaction gets posted to the blockchain. Now, I often get asked, what if you just wanted to corrupt the system? Well, that was a real risk in the early days of Bitcoin because there weren't very many computers that were contributing to the network. There weren't very many miners, so you could ostensibly get them together in a room and get them to post fraudulent information. But today we have literally tens, hundreds of thousands of these computers scattered all over the world. And so the financial and the practical incentive to be able to corrupt the system is now impossible. And every day, as more miners join the network and as the price of Bitcoin goes up, Bitcoin as a form of money becomes harder and harder. Now, where are we in terms of global adoption of Bitcoin? We have about 300 million wallets globally that own Bitcoin. By most accounts, people have more than one wallet. And so you're probably looking at about anywhere between 50 to 100 million people that actually own Bitcoin. If we compare that to the early days of the internet, it's equivalent of being around 1998, 1999. And so even though Bitcoin's at $100,000, it's actually still very, very early in its evolution. The second thing that's important here is the volatility of Bitcoin is what scares most people, causing them to think that it's a scam. But the reality is this, is when gold was first introduced as a store of value, its volatility was equally as wild because people were still coming to grips with understanding the idea of what it makes a good store of value and the acceptability of it. And so as the world has accepted Bitcoin more and more, its volatility has decreased. Now, if you're wondering about the acceptability and the adoption of Bitcoin, just consider this. We're still very early in the cycle. We're around 100 million people that own Bitcoin, which is around 1998 of the internet. But we already have governments that own Bitcoin. The largest asset manager in the world, BlackRock, is an advocate for owning between 2 and 5% of Bitcoin in your portfolio. You have the US President Donald Trump now, who wants to make the US the capital of crypto. And you have central banks that are now starting to own Bitcoin as well. And so for me, it's very clear that Bitcoin is the hardest form of money. It is the best technology we have to represent a store of value. The acceptability is becoming universal by the key players, governments and large institutions. And so hopefully this video gives you the high-level thesis around why Bitcoin is so valuable and how it works.